Good morning, everyone. I'd like to welcome you to this morning's webinar on the ongoing discussion in Massachusetts, for the moment tabled, regarding the wisdom or lack thereof of raising the GILTI tax. This morning's webinar is hosted by the Mass Opportunity Alliance. I'm Jim Sturgis, Executive Director of Pioneer Institute. I'm one of the three founding members of the Alliance, together with the Mass High Tech Council and the Mass Competitive Partnership. Over the last year, the Alliance has grown to include more than a dozen business groups representing more than 10,000 employers. Our goal is straightforward, to unify the business community around a winning agenda that reinvigorates business and job growth in Massachusetts. We want to restore Massachusetts to its rightful place as a national leader in innovation and economic prosperity. Tax policy is central to competitiveness, and we know that there are serious concerns about tax policy broadly written in Massachusetts. There's a sense of cost uncertainty, and there's the view that we are putting ourselves in a position where we're disadvantaging ourselves compared to competitor states. We believe that these issues must be taken head on because of their impacts on jobs and investment. So that brings us to this morning's conversation. There are discussions currently around expanding the GILTI tax. Let's define GILTI. GILTI stands for Global Intangible Low Tax Income. In plain English, it's a tax on foreign earnings of local companies, even when that income was already taxed overseas. What kinds of Massachusetts employers are affected by GILTI? Think biotech companies, medical device makers, software companies, and advanced manufacturers. Some of the very industries that anchor our innovation economy. Today's discussion focuses on the proposed changes to GILTI, which is currently set at 5%, and what an increase would mean for employers, for innovation, and the economic future of Massachusetts. The webinar is about understanding the facts, the risks, and the choices that we have. We have an outstanding moderator and panel with us today to help us understand those choices. And throughout, we'll make a concerted effort to cut through the jargon and explain clearly what is being proposed and what it would mean for Massachusetts. It's my pleasure to introduce Larry Edelman, senior columnist at the Boston Globe, whose recent reporting brought statewide attention to the GILTI debate and its potential fallout. Larry will guide the conversation and keep the discussion grounded and moving. On our panel, we're joined by John Cantalupo of Ernst & Young, a national expert on corporate taxation and foreign source income, and Carl Frieden of the Council on State Taxation, one of the country's leading authorities on multi-state tax policy and law. They bring both technical depth and broad economic policy knowledge, and together they will provide clarity on what is sometimes a very complex issue. Thank you, John. Thank you, Larry, and thank you, Carl, for joining us this morning. Larry, let me turn it over to you.
Thanks very much, Jim. I am here to moderate the panel, and I just want to put in this disclaimer that the views expressed here are neither mine nor the management of the Boston Globe. As a journalist, I will try to press people on issues here and not just take one side of the story. So let's kick it off. I wrote a column that looked at a proposal that is backed by the same people who brought us the millionaire's tax in Massachusetts. That is the tax that put a 4% surcharge on incomes above $1 million. And that was quite a divisive issue here. And now their focus is turned to GILTI, which is basically a way of taxing foreign income earned by U.S. companies. And the reason, as far as I can discern from talking to them, is that it would capture some of the profits that corporations successfully stash overseas by putting some of their more valuable assets overseas, patents, intellectual properties, and so forth. We've seen this play out with Apple and other big high-tech companies. So the question really is, is this a tax that one, Massachusetts needs, or two, would just worsen the competitive situation that we are already in? I've done a lot of reporting on the problems that costs in Massachusetts are causing businesses. We're talking about energy. Uh, we're talking about unemployment insurance. We're talking about personal leave and family leave income taxes, taxes on payrolls for that. And Massachusetts isn't the worst state by far in the country when it comes to taxes, but neither is the best state. And we and our employers struggle to attract talent, to keep talent here, to keep jobs here. So let me kick it off by going to John. And John, beyond guilty, what are the terms that we're dealing with here? Because guilty is really now something of the past, right? Due to the big beautiful bill,
Yes.
it's been redefined, so fill us in on that. What exactly are we talking about here?
Yeah, for sure, Larry. And Jim, thanks for that introduction. I think I'm going to take you with me everywhere. I've never been called an expert before, but I will definitely take it. Right. We're tax geeks and we use acronyms a lot. And so we're going to try not to do that today. But some terms that you might hear through the next half hour or so is, who is this really applicable to? And really, it's applicable to what we refer to as U.S. multinational corporations. They can be public companies, publicly traded, or private companies that are U.S. based that have foreign entities that sit below them. Those foreign corporations we sometimes refer to as CFCs, controlled foreign corporations. Those entities earn money outside of the US, and that income was previously referred to as GILTI, Global Intangible Low Taxed Income. They recently had a tax law change, and we'll go through some of the history, I know, Larry, in a little bit, where they changed the term of guilty to net tested CFC income. And they changed some of the kind of the characteristics around it, around the margins. But generally, the approach is that income earned outside of the US is taxable in the US for federal purposes, and you're allowed to take a credit to avoid double taxation for federal tax purposes for taxes you paid in that foreign jurisdiction. So there is no double taxation, or the hope is there's no double taxation. Other terms you'll hear as we go through this, and most relevant is for companies that are US multinationals that have foreign corporations that actually have a presence in Massachusetts, right? So we'll refer to that as either nexus or apportionment, right? So if you have a presence in Massachusetts, that means a piece of the federal pie gets carved up and that is taxed in Massachusetts. And the question is, how is that foreign income taxed in Massachusetts vis-a-vis the federal rules and some of the other states? And is it competitive with the other states?
John, a quick follow-up there. If there's a dividend or a tax credit that is supposed to offset this, why bother at all? What is the purpose at the federal level of the foreign income tax? Let's just call it that from now on.
Yeah, for sure. So the purpose of it, obviously, the purpose is they would rather have, from a federal perspective, they would rather have all their intellectual property and all of their capital and all their manufacturing here in the U.S., right? That's the whole policy in general. And so when you have guilty income, they're saying, look, you're a U.S. multinational. You chose to move some of your income offshore. We're going to tax that in the U.S., but we will recognize and give you a credit if you did pay foreign taxes. Now, the break even rate for that is around 13 or 14%, depending on what year and what the term is. But way back in the day, a lot of companies would move their income offshore, and the effective tax rate of that foreign earnings was substantially lower than 15%. Now, there's been a shift around the globe where worldwide tax rates are probably rising up to 15% as a result of all of this and the interplay. But way back when, Larry, there was a time where you could pay 2, 3, 7, 12% on your foreign earnings, defer them from US taxation, or when you brought the money back to the US, you would have to pay tax at the full US rate, allowed to be offset by any taxes you might have paid outside of the US.
Okay, so this is, if to boil it down, and correct me if I'm wrong, this is an attempt by the federal government to make sure that multinational corporations are paying at least a minimum tax on their income, and not to really stash profits in places where they can get a very low tax rate. So
I
if
think
they've
that's well
done
said, Larry.
Okay,
That's
so
well
if they've
said.
done that, they're going to be subject to a tax here that brings up the effective rate to something closer to what the U.S. charges. That's great, John. Thanks very much. Carl, can you very quickly distinguish how the Fed's uh, uh, tax foreign income, especially under the new rules that are going into effect, versus what Massachusetts currently does?
Sure. So, I mean, about a minority of the states, 15 to 20 states, over the last 50 years have followed loosely what the federal government has done in terms of taxing foreign source income. So until the Tax Cuts and Jobs Act in 2017, the U.S. sort of took the lead, and the U.S. approach to taxing foreign source income at the federal level was to tax 100% of foreign income, but only when it was dividended back. And the problem was it often wasn't dividended back. So in 2017, the U.S. again took the lead in setting up what became a global minimum tax, which is to say, okay, we're not going to tax this income on a deferred basis. We're going to tax it on a current basis, but only roughly half of it. The states, a minority of states in the past, glommed onto the federal method, but usually didn't pick 100% or 50%. They usually picked 5% or 20% or something, and they taxed a smaller percentage of it. Most of the states, Mass historically has only taxed 5% of what the federal government was done. Most of the states don't tax any of it. So the setting here is there are some states that follow the federal government. Most of them don't tax as much or include as much of the foreign source income in the base as the federal government does. And the majority of states don't tax any of it.
Okay, okay. And what does the proposal in Massachusetts, the bill, which is currently not moving forward, but if it does get picked up, what does that do?
So the bill would change Massachusetts from taxing roughly 5% of the foreign income to taxing either 50%, or it could change in 2026 and go to 60% if it was following the way the federal government was doing it. So that's a tenfold increase in how much foreign source income would be taxed in Massachusetts. That would put Massachusetts, if it did it, in a distinct minority, because among the 15 or 20 states that have at different times taxed a portion of foreign source income, most of them were like Mass. They tax between 5 and 20%. There's only a handful that tax as much as 50%. And when you get to the larger states where the real headquartered companies are that have lots of foreign income, there's only 3 other headquarter states that are attempting anything like what Massachusetts is attempting and taxing 50% or perhaps 60% of global income.
Yeah. So how much money are we talking about here at the Massachusetts level? Like if the goal is to capture some of those foreign profits and help the state budget, which is under stress from federal funding cuts, how much dough is at stake here?
Um, You have I think it's, that there have been some initial estimates. They don't know for sure, but it's, in the 100 million plus a year range. It could be quite a bit more than that. We don't know. But part of the reason, and we'll get into this, Larry, that it's so much is because the approach Massachusetts is taking in calculating how much they would tax is almost clearly unconstitutional and brings in way more money than either the federal government's going to bring in or almost all the other states are going to bring in. And so they're calculating it in a way that would bring in more money than they should be getting, and also in a way that's unconstitutional, in my opinion.
Why is it unconstitutional? I'm not a lawyer.
Okay, so let me just normally the way it works, and this is certainly the way it works when, if Massachusetts, is taxing income and they're trying to figure out, let's say, just in the US, and they have, let's say you have a business that has 5% of the income that's earned in Massachusetts, the way they figure that out is take all the income earned in the US and then they look at the sales in Massachusetts over the sales everywhere. And they calculate, and I'm just giving an example, that they calculate that 5% of it is earned in Mass, and then that's how much they tax. the way that Massachusetts is doing this, and there's only two states, and it's only the last 2 years, Minnesota and Illinois, that ever have done this, and all the taxation in the last 75 years that we're talking about in terms of states taxing foreign source income, all of them used a methodology different than what Mass is proposing in these two other states, which are going to be in litigation for years. And that is, they're bringing in the foreign source income. And so the tradition in apportionment is you bring in income into the base. So they're bringing in, say, 50 or 60% of foreign income. But you're also supposed to bring in the foreign sales that are attributable to that. Let's say, there's 5 foreign sales for every dollar of income. Those come in, they go into the denominator, so your income goes up, but the percentage that's in Massachusetts goes down because that's income being earned abroad. Mass is saying if you under GILTI or necktie, they're not going to allow you to calculate based on those foreign sales. You can't bring them in. You're only bringing in the income, not the sales. And so they're going to be taxing foreign income differently than domestic income, which allows you to look at all the sales that contribute to it. It's going to increase the percentage that's taxed in Massachusetts, and in my opinion, violates the Commerce Clause because you can't tax foreign income differently than domestic income.
And that's, Carl, what I affectionately refer to as heads, Mass wins, tails, corporate taxpayer still loses, right, Larry? There's no dilution in the apportionment factor. They're going to take 50% of the income and they're going to tax you in Massachusetts, but they're not going to allow, in Carol's hypothetical example, that 5% apportionment to be diluted at all, right? By including the foreign sales that derive that income in the calculus of that 5% numerator and denominator.
Yeah, so just to give you an example, if you have $1 billion of domestic income and you bring in $1 billion of foreign income, so you have 2 billion, and you're a 5% in Massachusetts based on the domestic billion. If your sales ratio to income is the same, and foreign as domestic, your apportionment percentage should go down to 2.5%. You bring in the foreign sales, and so you're multiplying 2.5% times a bigger number, and you might end up, give or take the same or a little bit more. They're not going to bring that in, so they're going to take all that income in and they're going to multiply it times the same 5%. So basically, they're saying all that foreign source income is earned in Massachusetts, which just can't be. And so this case has never gone to the U.S. Supreme Court, but similar cases have gone to the U.S. Supreme Court, which lead a lot of people to believe that they shouldn't do this. Now, I want to distinguish, you can constitutionally at the state level tax foreign source income, but for like 75 years now, every state has done it differently. They've put something into the apportionment formula to reflect the foreign sales. The federal government and all the other nations in the world do something simply. They bring in, as John was saying, they bring the income into the base, the foreign income, and then they allow a credit. If you pay taxes in other countries, you get a credit for those taxes. And so if the goal is to tax all foreign income at 15%, and you're being taxed abroad at 15%, there is no foreign income in the federal base, whereas there will be under this formula in Massachusetts, which is quite disturbing.
Okay. Jim, given this, what is the potential downside for companies in Massachusetts? Your organization, MOA, positions this as a competitiveness issue that puts Massachusetts at a disadvantage to other states. How so?
Well, if we're just focusing specifically on GILTI itself, I'd say there are probably 3 points to make, Larry. The first one is, look, the competitor states get it. They're competing for talent and they're competing for investment. And they're looking to attract employers where they can. And it's for this specific tax, there are competitor states like California, Florida, North Carolina, who don't impose a GILTI tax at all. And I'd say for me, North Carolina is a really interesting case study on this and other issues, in the sense that North Carolina is, I don't want to make it all about North Carolina, but North Carolina is a state that is lowering its taxes. It's attracting a lot of talent. It has an industry mix, if you take a look at the Research Triangle and Charlotte together, it's very similar to Greater Boston. It's about the same size. And over the past 5 years, they have grown about 255,000 jobs. We've lost 30,000 jobs. Therein is about $1.5 billion in tax revenue that we've foregone. I'm not saying everyone moved to North Carolina. I'm saying people considered both states. We've got a lot of things that are in our favor, but they chose North Carolina. A number of them have. That's we're in that kind of competition. And what about GILTI is especially important to us is that we've looked at the numbers around where the what you might call the professional, scientific and technical jobs are, and our strength over the past 5 years as well. And we see a distinct weakening in Massachusetts compared to North Carolina, Florida, Texas, and other competitor states. This will not help in that competition for talent. At the end of the day, investment follows talent. Talent's the real game. Can we retain the talent that we need to succeed? And historically, for 30 years, Massachusetts did a better and better job of that. We shed a lot of our Massachusetts label. I mean, honestly, we got to the place where we're kind of middle of the road. When you take a look at corporate taxes today, we're not close to middle of the road. The Tax Foundation puts us about 43rd, I think, 7th from the bottom in terms of corporate tax burden. We've got an estate tax. Some of our competitors don't have that. The millionaires tax, what people forget is that it impacts S corporations, and there are large employers here. There are a lot of the small business, mid-sized business spine of our employment base. This is just one more hit to that reputation. And it's also a hit to, if people just do the calculation, they're starting to say, well, talent's going elsewhere, and they're going to follow that.
Larry,
Sure,
I
go
was
ahead,
just going to add
Paul.
one point, which I think goes back to what we were talking about before, which is important, is to say that Massachusetts shouldn't adopt this legislation. I think that's the position all of us are taking on this webcast, is not to say that there is not a problem there. There clearly has been a problem. It's been recognized. The state level has been recognized by the federal government. It's been recognized by most of the nations in the world that, given international competition, and some countries are low tax and some are high, there's a problem with companies having the flexibility, nothing illegal about it or anything, to move assets, and particularly intangibles, into lower tax nations. That is a problem. The question is, how do you address that problem? And the federal government in the US and the other major countries in the world have all come up with a solution for the first time in the last 10 years, basically following the US model, which is to have a global minimum tax roughly around 15% at the national level, not the subnational level. This conversation we're having here couldn't happen anywhere else in the world, because no other country, and a bunch of them do have states or provinces, is trying to solve this problem at the subnational level. And so the problem you have is, when you have the federal government doing it and coming up with something that's roughly equivalent to what they're doing in Europe and trying to tax this global income at least at 15%, if the states come in on top of it, they're going to cause a competitive problem, because all of this GILTI income only applies to U.S. multinationals. You can only do this to your own multinationals. So you have the U.S. states and the federal government increasing the rate above the global minimum tax, of Mass and other states doing it. And then even worse, Mass is trying to do a complete outlier, not only taxing more of it than almost all the other states, but doing it in a manner that doesn't allow for, essentially, what's a foreign tax credit in other countries, doesn't allow you to focus just on the low tax income. Mass can bring in high tax income, low tax income. They don't care. This is just a money raiser. And I don't think everybody proposing it understands how it would work.
John, I have a question for you. Why not do any states just totally mimic what the federal government does? It sounds like Massachusetts is doing it differently. We're coming up with our own method, our own formula for this taxation. Would it make the matters better? Would it simplify the situation if Massachusetts just exactly replicated what the federal government does?
Yeah, I think it's a great question, Larry. I think, and Carl, you can jump in here as well. Most states, right? So if you think about how states tax federal income, their starting point is federal taxable income. They look at your federal return and say, what's your taxable income as a starting point? Majority of the states don't tax foreign earnings at all, right? It's an adjustment out of foreign earnings. So if you have GILTI income or any other type of income, they just say that's an adjustment, and you back it out of what's taxable in the state. There's a bunch of states that just entirely back it out. There are a handful of states that say, hey, we'll tax about 5% of the foreign earnings. And then there's the Minnesotas of the world and potentially the Massachusetts of the world. And I think, Carl, maybe 3 or 4 other states, but certainly a minority of states, Larry, that are saying, no, we want, We want a bigger piece of that pie, whether it's greedy or not. We want 50% of that income or something like that. So I would say, Larry, most of the states don't tax this income at all, or they have an immaterial tax on this overall income. So they haven't had to get to the point where they need some type of crediting system at the state level.
Yeah.
So, and just, can I just add to that, Larry? Because
Absolutely.
the states don't do this, never have, and it's not just with foreign source income. They don't allow credits for taxes paid to other
Right.
jurisdictions within corporate tax, just for different, administrative purposes. So what they do is, instead of saying how much tax was paid in the other jurisdiction, they use apportionment. That's what we were talking about before. They take all of the income and then they use a sales factor, how many sales in mass over how many sales everywhere. The problem here is, and that's sort of traditional, it's a rough equivalent to saying what taxes were paid. The problem with the mass proposal and the two other states that are doing this, they're going to be under, major litigation on this, is that they're not allowing the apportionment formula to work. The normal apportionment formula is bring in the income, bring in the sales that contributed to the income. They're not allowing you to bring in the sales. And so not only are they not allowing you a foreign tax credit, but they're not using the equivalent system at the state level that they usually use for domestic income.
Okay. Jim, you mentioned North Carolina, and you've mentioned the lagging job indicators here in Massachusetts. And in the most recent month available, which was September, Massachusetts lost 11,100 jobs, which is quite a lot at the local level. Now, that's a volatile number. It may be revised. Nonetheless, we have a job creation problem here. I think that there is skepticism among opponents of this proposal, that this would actually impact a company's decision to add jobs here, move here, that kind of thing. What do you hear on the ground from companies?
So I would say what I hear from companies, look, the business community has every business is different. They all have different issues. Some will say that energy affordability is the number one issue for them, or someone else will say UI is the issue for them if you're in construction or something like that, right? But if you take the totality, and especially if you're thinking about knowledge economy businesses, the things that we hear over and over again are taxes, number one. On the other piece of it, it is two components of compensation, of what I would consider compensation: housing affordability and healthcare costs. I think Mark Williams' study at Boston University made that very clear vis-a-vis competitor states. I think it's a year and a half ago he put out a landmark study. I think that made that case convincingly to me, and I hear it from people all the time. Fixing housing is especially hard, obviously, because it encompasses working with 351 communities. And the healthcare cost is one that I think Massachusetts had a real tough time fixing. What we see around the country, and what I think is most appealing to the business community in terms of action right now, is related to taxes, because they see 25 states that have lowered their taxes significantly. We did a little bit a couple of years ago, but it was not even close to what we did in 2022 in terms of the impact of the so-called millionaires tax, which is not that, in my opinion. It's a tax on S corporations and others. That's what we hear about. They want to see some action that's related to making us competitive with other places. So if they think about investing here, they know that they're getting the return on investment they can get elsewhere. We hear it over and over again. I see it in the polling as well. Larry, if you go back 10 years ago, the polling wasn't nearly as strong for tax relief or affordability relief. Affordability relief is probably the number one issue we see in polling if you're a household or if you are a business.
Okay. Carl, the point of GILTI, at the federal level was to try to encourage multinationals to keep their profit-producing assets in the United States. Has that been successful at all? Is there any way to know whether that's been successful? Or has the trend of offshoring those assets just continued apace?
Well, I think the trend has definitely gone down. It is not, they're still experimenting at the international level. I mean, US is trying it around 14 or 15%. They're even revising already GILTI to make it a broader base. Other countries are doing something equivalent under the auspices of the OECD. It's not the only factor, obviously, Larry. I mean, there are a lot of other factors that play into that. I'm sure the Trump administration is trying all sorts of things, tariffs and so forth, or whether you agree with them or not, to create more investment in the U.S. and less abroad. So but to answer your question slightly different way, there are two things that the proponents of these proposals are pushing, and I want to address because they have serious concerns. One is low tax income, and as I said before, profit shifting and low tax income is recognized as a global problem, but it's being addressed and it should be addressed at the national level. And the U.S. is addressing it just as well, if not better, than other countries, and they're still working on it. The second problem is that the OBBBA is going to be cutting significant amounts of federal aid to states, and that's a great concern to Massachusetts. And so the question is, what do you do about it? To focus on that and say we're going to be losing a lot of Medicaid, money and SNAP money, that's realistic, and I don't disagree with that. My problem is there's a lot of budget and tax solutions to that after we figure out how much that's actually going to be and what we want to do about it. The one thing you don't want to do is to enact an outlier solution based on foreign source income that states shouldn't be taxing in the first place, and do it in a way that's likely unconstitutional, which means you're going to have to give back all this money in 5 years. That's not the way to approach the problem. So I totally am sympathetic to the reason people are looking both at foreign source income and the problems with how do you tax global income, and also potential significant cuts to Massachusetts and other states because of the recent federal legislation. Question is, what do you do about that? And the thing you don't do is do something that Jim's saying is going to make the state less competitive. And what I'm saying is likely not going to work, and you're probably going to have to give all the money back at the end if it loses in the courts.
And I would add, guys, right? I always say when you throw a rock in the water, it's not only the rock, it's the ripples and the waves that as a result of it. And so you think about all the indirect effects of this, right? It's easy to kind of, if this goes through, you vote with your feet, right? And so if people start to leave Massachusetts and they set up their corporate headquarters elsewhere, right? Jim, you know this, that's less payroll tax. That's less people buying subs at the local sub shop. That's less, people getting gas at the local Massachusetts gas stations, right? There's all coupled with the millionaires tax, a lot of this stuff is saying, are going to make companies make decisions that will have an indirect impact on the overall Massachusetts economy.
Okay. For Carl, what then? I mean, since Massachusetts has been taxing foreign income for a while, and since the state is in need of additional revenue, is there instead of taking it up to 50%, is there a level that would keep us within the general vicinity of competitor states? And so would bring in some more additional revenue, but not put us as an outlier. Is there a way to kind of calculate what that might be?
Do you want me to bid against myself? So, the answer to that is twofold. And again, it's a great question, Larry. But one is, how much, if any, do you include in the base? And the second thing is, how do you apportion that? What formula do you use? And so both of those are issues. So just to answer the first part of your question, if you look at the other states, other than the couple outlier states I mentioned, which are our competitors, California, New York, New Jersey, Pennsylvania, Texas, Florida, Ohio, Washington, Virginia, Georgia, none of them tax. Most of them don't tax this, or if they do, California has slightly different, but they go up to around 25%. The other ones are at 5% or 0. So if you're looking, I'm not going to recommend anything on this account, but if you're looking to do something different or more similar to what other states do, one, you don't include any of it because the federal government's handling it. Or two, if you do, you're somewhere in the 5 to 25% range. But the second point that's really, really important is all of those that I mentioned have some sort of apportionment. They bring in the foreign sales, unless they're just taxing 5%. That's different. Mass doesn't bring in the foreign sales now, but it's only taxing 5%. And there's different rationales for that. But once you get above 5%, all of the other ones I mentioned, other than these two new ones, Minnesota and Illinois, which are only 2 years old, and they're going to be litigated for years now, all of the other ones bring in less share of foreign source income than we're talking about, or none. and they allow you to apportion it based on your foreign factors. And Massachusetts is following this crazy pattern that only started 2 years ago on 100 years of state corporate income taxation. Only in the last 2 years has anybody tried this crazy idea to bring in a lot of income without allowing the factors to come in. So there's two problems to your question. One is, do you put anything into the base? Okay, and if you do, at least use the same formula you use for domestic commerce, which is to apportion it, decide how much is in Massachusetts. That's not what Massachusetts is doing, and that's the most problematic thing about what they're proposing.
Okay.
Yeah, and I agree with you, Carl. And Larry, again, it's back to the heads they win, tails the taxpayers lose. They're not allowing, they can toggle up the percentage from 5 to whatever they want to toggle it up to, but they're not allowing the relief in the apportionment factor.
Okay. Does the single sales factor, which was passed by the legislature, factor into this at all? Does it have a role, or is that a separate issue?
It only has a role in the sense that, compared to 25 years ago, when almost none of the states had single sales factor, they used, they would include in deciding how much was earned in your state, they would look at your property compared to other states, your payroll compared to other states, and your sales. 3/4 of the states have changed to sales now. So they just look at sales in your state compared to sales in the rest of the country, or in this case, in the rest of the world. It only makes a difference in the sense it's a different formula. It really doesn't change anything other than the fact that they have always been based on the principle for the last 100 years that you look at the sales in your state compared to the sales everywhere else, or the property in your state compared to the property everywhere else. What Massachusetts is proposing is to look at the sales in your state and then don't allow you to look at the sales everywhere else. It's just, it fundamentally violates the basic principles of apportionment.
Okay. So just to be clear then, Massachusetts isn't proposing to raise the corporate income tax rate. It's just proposing to increase the amount of foreign income that can be charged that same 8% rate. Is that correct?
Correct. And that's true with every state that does this. It's an independent issue with the rate.
Okay. Okay. Jim, when it comes to competitiveness, what industries, you mentioned this at the top, but I'd like to go into a little more detail. I mean, for example, is this a big issue in the biotech world? Because they have a lot of intellectual property. Is it a big issue in financial services or in software high tech? Let's get a little more color on that.
So for the life sciences, definitely yes, especially for companies that are not just in R&D. We do have a heady R&D component to our life sciences sector. That will be impacted only partially, but not as much. Software, definitely medtech. We have a lot of medtech. And I think it's probably more on the advanced manufacturing side. So if we're talking about aviation or those sorts of things, instrumentation for aviation, definitely look, it may not be the most popular industry, but defense-related industries definitely factor in here. Those are definitely.
I think, Jim, the answer to the question is all of the above, right? So if you think about it, any company that has a global reach and has a global supply chain or foreign customers and is inevitably going to leave some income in those foreign jurisdictions. And then the question becomes, why should Massachusetts have the chance to tax that income just as a result of you being a multinational global company with a global supply chain?
And you don't have to have investments in Asia and Europe and so forth. If you have investments and earning income in Canada and Mexico and Latin America, that's GILTI too. I mean, it's not limited to, faraway places in the world. It's anywhere outside the U.S. border. If you have income from there, which most of our great companies in Massachusetts, the reason they're great is because they're global companies, then they're going to be impacted by this.
Okay. I'm going to ask one more question of John. But before that, I want to remind our listeners to raise your hand on the bottom of your Zoom screen there if you want to have a question, and we'll get to them in just a few minutes. John, you deal with very big companies. Does this even show up on their radar? If I'm a multinational company operating not only in Massachusetts but across this country and in countries around the world, is this a rounding error?
No, this is something that they would, care about, Larry, right? So if you think about large, global, multinational, publicly traded companies, a big part of what they care about is earnings per share and effective tax rate and all of that stuff. And so state taxes is a big component of what makes up your global effective tax rate. And if your tax rate is 23% versus a competitor's at 21%, you can question as to whether that drives share price or not. And so it does come up to the radar. Is it as big as a significant federal tax change? No, but I think Carl alluded to it. It's a 10x increase, right? Based on what they've proposed, Carl, the Massachusetts tax that any of our corporations pay would go up 10x from what it currently is. And that could have an impact. So they do pay attention to it, Larry.
Okay, and at the federal level, um, it's my understanding that changes will take place in 2026 that will impact multinational companies. Can you explain that briefly?
Yeah,
What's
yeah,
going on?
for sure. And so kind of not go back to the gory history of kind of
Yeah, just
federal taxation. 2017 put us on a level playing field. And actually the changes that were just made in this, I call it HR one because I hate to refer to it as the one big beautiful bill.
yeah.
We'll call it HR one. But actually what they did is they made changes that made the ability to use foreign tax credits much easier. Right. So there's a calculus to use foreign tax credits, and companies that have a lot of research expense and interest expense prior to this tax law change found themselves paying foreign tax, but not maybe having the ability to use those foreign taxes to offset U.S. federal taxable income. The changes that were made recently actually make it more advantageous and more accessible to get to those foreign tax credits to eliminate that double taxation. So I would say, Carl, I think you agree, like these changes were actually helpful at the federal level for the use of foreign tax credits.
So this is one of the ironies, Larry. It's an important one, which is a lot of times you would think if you do something at the federal level and then you copy to the state level, like let's say you accelerate depreciations and allow 100% expensing, it has roughly the same effect. If the state adopts it, they're going to encourage investment in their state because it's going to be 100% expensed in 1 year, like it is federal. This is one of the few areas where what you do at the federal level has a completely different outcome if you try to mimic it at the state level. And so let me give you an example of that. The changes from GILTI to what we're calling NCTI, NECTI, which is the new formula, were roughly a wash federally. And the reason they was they increased the amount that was subject to tax from roughly, in our terms anyways, 50 to 60% of global income. It's a little different how it plays out federally. And they got rid of the largest single deduction. You were allowed under GILTI to deduct 10% of your investments abroad, in plant and factory. It was a huge deduction. That's gone now. And so federally, they offset that by making foreign tax credits easier to get. That worked. States don't copy foreign tax credits. So in Mass is a rolling conformity state, meaning it usually picks up, if it's adopting a provision within the code, it picks up the current one. We don't know what they're going to do with this legislation in 2026, but if they follow what they normally do, they'll go from 50% to 60% of global income will be in the tax base in Mass if they kind of copy what's happened this past year. And this major deduction is gone. So they're really taking in all the foreign source income and not allowing any normal return on investment. That is only a worse solution at the state level. Federally, there's other things, as John mentioned, that offset it, that make it kind of a wash. It was supposed to be a wash. At the state level, it's extremely onerous. And then on top of it, if Mass follows with these two outlier states, Illinois and Minnesota doesn't allow normal apportionment to occur, you got a really, really bad result, which is even worse than the one that was proposed a couple months ago.
Okay. Thanks very much. At this point, again, please don't be shy. Ask your questions. And I'll go to the first one, and that is, what are the two other states that are considering a proposal that is similar to Massachusetts? Carl, why don't you take that one?
Yeah, I mean, there's two other states that did it. So that's Minnesota did it in 2023 and Illinois did it in 2025. Those are the only two that have done it. California in 2021 considered something similar, didn't pass. And when I say similar, it's taxing roughly half of global income without any apportionment. Other states, as I mentioned, have taxed 5 to 50% of global income in the state base, but they've allowed the apportionment factors in. I'm sure there are other ones that are going to propose it. I don't know in 2026, but there are other states thinking of it this, but there's only two states that have ever done it. And I should say they've only done it in the last 2 years, and the lawsuits are beginning. This is not something that's very likely to pass constitutional muster.
Yeah. John, what do our neighboring states do? New Hampshire, specifically, since that is one of the high level competitors that we see in a competitive sense. Where are they?
I think I'll let Carl. Carl's
Oh,
our
you let
state
Carl answer.
expert.
Okay, sure
I'll
thing.
let
I'll
Carl
answer
take
that. So
that one.
if you look at New England, just look at the New England states, New Hampshire and Vermont tax 50% of global, they include 50%, very, very small states, not headquarters states, but they include 50% of foreign source income in their base, but they allow the apportionment. Okay, so they allow actually full apportionment factors like they do on domestic income. Connecticut taxes 5%, New York taxes 5%, like Mass does. Pennsylvania doesn't tax any. It varies, but they're only in New England, the only states that are taxing right now 50% of foreign source income are doing it in a sense that they're using the appropriate apportionment the way they do domestically, and they're small states. None of the other big states in New England are actually doing what is being proposed in Massachusetts.
Okay. I am told that we have a question from Thomas O'Rourke. Tom, if you could just put your microphone on and ask that question live, it would be great.
Yeah, thank you, and thanks for this presentation, shedding light on this. You mentioned in the beginning that this was backed by the same folks who brought us the millionaires tax recently, and in doing so, they did two things. They did that through ballot initiative, and they earmarked the funds towards transportation and education. In this case, do we know if the funds would be earmarked in any particular case, or they just go to the general fund? And if this does not get through the legislature, do you think it would go to the ballot box?
I can take that question, and then if I get it wrong, panelists, please feel free to correct me. I believe that there is no earmarking of the revenue that would be raised by an increase in the GILTI tax. I don't know for sure whether the group, which is largely backed by the Massachusetts teachers unions, would take it to the ballot, but I wouldn't rule it out given the success that they've had in the past with the millionaires tax winning at the ballot box. Did I get that right, guys?
I think that's fair.
I think that's right. And also, just as an addendum, Larry, I'm not aware of the 18 or 20 states that tax small to medium portions of foreign source income. I've never seen one that targeted it to a particular use. It's a very fluctuating amount, and it's not something that I've seen. But the possibility that they would do it as a ballot initiative, that's always there.
Yeah. Jim, do you get a sense of the temperature at the legislature right now? The receptiveness to this?
Look, I think it's they're skeptical, and I don't think they will take it off the table, but I think they're not keen to doing something like this. That's what we've heard.
Okay. Among our audience, any other questions out there? We're going to wrap it up, but we're happy to ask, answer any other questions if you've got them. So fire away. Don't be shy. Okay. In that case, I want to thank Jim and John and Carl for joining me on this webcast. I hope it's been informative for you on the webcast, all our listeners, and keep watching the Globe. We'll be updating this story as developments warrant. And thanks very much.
I'd like to also extend thanks to you, Larry. Tremendous job here. Thank you, Carl. Thanks, John, for being part of this. It is a thorny issue, and really appreciate your articulation of the issues in a very clear way. So I feel like I've learned a lot already as well. Just want to say thanks for Mass Opportunity Alliance, for your support of Mass Opportunity Alliance. Would urge you to go to the massopportunity.org site when you can. There's always new research, communications. We are working to make sure this state can grow jobs, grow investment, and return to a place where truly we believe that we have a rightful place in the country, a leadership position in innovation and growth. We want that back. So thank you very much.